Well, to give us some analysis around all of this, some colour, what that means in terms of investment strategy, we are joined by George Lucas from Instreet Investment. George, always great to see you on a Monday.
Thank you very much for having me.
Thanks for coming in. Well, just firstly, in terms of all that data we were just watching there, we've got the FOMC meeting. What's your sense, though? Is this likely to be a non-event?
Yeah, I think it's going to be a non-event. I mean, as they are data watching, there's going to be no good data now probably until January, no reliable data that they can rely on. And so... and especially they want to see what effect the government shutdown had through the economy as well. And so they'll just have to be, we expect them to be on hold now probably until the first quarter, which probably means to March next year that they'll be on hold. And they'll just maintain their current bond buying purchases. So the meeting's likely to be a non-event.
In terms of, I guess, the data that we can get full access to, like the private surveys and the corporate earnings, do you get any sense, though, that perhaps the economic recovery is on track, it is okay, and maybe that means that tapering is going to have to happen at a faster pace when it does happen?
Well, from a corporate earnings point of view, at the moment the corporate earnings, the season started off a little bit slow, but the recent numbers that have come out have actually improved the earnings, and we've actually seen top-line revenue growth now catching up to earnings growth. So we have an earnings growth at about 4.3% and top-line revenue growth at 4%, which is what really the market was looking for. And as more and more companies report, because we've only really done about 50% of the S&P 500, we're seeing these top-line numbers improve for the the overall market. So from an earnings point of view, there's a lot of support for the market. The big question is if the Fed starts tapering in March, will they speed up the program, because they did say that they're going to want to start raising interest rates in late 2015, or will they also postpone the interest rates rises into 2016 and have a similar tapering? And we're really not at a point that we can say that yet. Which, it is data dependent. And the other thing we have to be careful about is the S&P 500 is a global market. It's not really. So a lot of the earnings are generated from offshore. So it's not necessarily a true reflection of what's happening in the US. It is a reflection of what's happening in the world. And globally, the world seems to be improving.
Okay. Just in terms of, I guess, talking through that then, obviously we get a lot of data out this week to help sort of give some colour around that. So your sense then is what? Europe stabilised, China, the growth stabilised there,
yeah.
Japan.
So Europe obviously stabilised. It's not going to come out of the box like the US has. It's not going to recover as quickly. Countries like the UK and Germany may, but not the whole of Europe as a whole. France, Spain, Italy are still going to be very sluggish in their recovery. From China point of view, we still see the growth between the 7.5–8%. We don't think we're going to get above 8%, so we don't see growth momentum continuing to pick up. We just see the growth stabilising there in China. And Japan's got a lot of numbers coming out this week, especially at the end of the week, and we expect them all to be positive. We do think the recovery is taking hold in Japan, but it is also very much on whether they can get the next set of policies through, whether that growth will be sustained for a long period of time. The thing about Japan is that, it's got a lot of room for these structural reforms, while other countries like Europe don't. So there's a lot of potential for Japan to continue to grow.
Just in terms, I guess, of some of the reactions we've seen, there seem to be worries last week about China, the rise in short-term money market rates, that perhaps we're looking at a big credit squeeze again, as we saw a few months ago, and then also a bit of sabre-rattling by the Japanese Prime Minister over the weekend against China, and a little bit of weakness being seen in the yen across some of the major currencies. Do you think, though, that investors just want something to worry about? Are you worried by those kinds of things?
I'm not worried about those type of things. I mean, we really do feel the markets are just going to continue to rally into the end of the year. At the end of the day, we've had a lot of this before in China, where interest rates have gone up, and short-term interest rates, and there have been, potential crises on the horizon. But the bottom line for Australia is that they continue to have double-digit export growth into China, and we continue to see their imports grow, and we continue to see iron ore prices remaining quite stable. So there's obviously, from an Australian point of view, a lot of demand for what we produce out of China, and so even these little short-term crises aren't really affecting the demand for our commodities into China. The Japan sabre-rattling with China has been happening for a while. It's on both sides, and it's always a risk, but it's hard to see where it's going to... In the short term, we don't think it's going to go very far, but it is a risk, because part of the Abenomics, or part of the aid policy, has been reinflating this nationalism in Japan, which is something that China won't like.
Just another, I guess, bullish indicator perhaps, I mean, in terms of fund flows as well. I mean, we're seeing equity mutual funds, I know you're pointing out big flows into that. Is there a sense that there has been a lot of cash on the sidelines too? I mean, we kind of can't discount just the amount of
like us, and we got it a bit wrong, is that we expected there'd be a lot more volatility in the market in October and September, and we kind of were sitting on the sideline, and a lot of fund managers did that, and they cashed up a lot of their bond portfolios ready to invest it into equities, and this volatility never occurred, and we only really had short, sharp pullbacks of 4 or 5%, and so no one's had time to get back into the market. And what we've seen over the last couple of weeks since the debt crisis is that a lot of money is flowing back trying to get into the market, which was hoping to get into the market on a pullback in September and October, which never occurred. So there does appear to be quite a lot of cash on the sidelines still.
Do we need to start worrying about inflation globally yet from all of the stimulus? I mean, I know it was something that was, has been sort of pushed out, saying, no, it's, at the moment, forget about it. But, I mean, is it something that we do need to start to...
I think it's something we have to focus on, especially here in Australia, because one of the reasons that the RBA was cutting rates was because they were worried about the employment situation, and the employment situation in Australia doesn't seem to be as bad as everyone expected. And the last employment report actually showed there was a bit of a stabilisation in the employment situation here in Australia. So we've got a stronger employment situation here in Australia than people expected. Plus, we've got rising housing prices. There is a bit of an ingredient for inflation in Australia, and I think the same could start happening, globally, especially in the US, where as their employment situation begins to improve as well, that the potential for inflation is a lot higher than people are giving it credence for at the moment.
Yeah. George, it's always great to get your views. Thank you so much for joining us.
No, thank you for having us.
George Lucas there from Instreet Investment.